Ever curious about the Indian stock market? It's a dynamic world where economic growth meets personal wealth. It revolves around two main exchanges, the Bombay Stock Exchange and the National Stock Exchange. Together, they form a platform for investment and wealth creation. Let's some common misconceptions and understand this exciting realm. Many perceive the stock market as inherently risky, but is it really? Yes, there is risk involved, but it's not quite the gamble some might make it out to be. Investing in the stock market isn't about taking a wild leap of faith. It's about making calculated decisions. You can manage this risk. How? Through diligent research, understanding the companies you're investing in, and keeping yourself updated with market trends. And then there's diversification, the golden rule of investing. Never put all your eggs in one basket. Spread your investments across various sectors, companies, and asset classes to reduce your risk. The stock market is not a sprint, it's a marathon. Patience and discipline go a long way in navigating the ups and downs. So remember, the stock market isn't a roll of the dice. It's a game of chess. And with the right knowledge and strategy, the stock market isn't as scary as it seems. Why does the stock market have a bad reputation in India, you ask? Let's delve into the reasons behind this skepticism. The stock market in India has seen its share of ups and downs, which has led to a certain degree of wariness among the public. Factors like high-profile scams have left a mark on the psyche of the Indian investor, creating a cloud of uncertainty around the stock market. Market volatility, which is a universal characteristic of any stock market, has also contributed to this perception. Furthermore, a lack of awareness and understanding about the workings of the stock market has added to the skepticism. But remember, these challenges are not unique to India. They are part and parcel of any financial market around the world. Despite the challenges, with proper knowledge and strategy, one can navigate and potentially benefit from the stock market. Let's look at some of the successful investors in the Indian stock market. The investment landscape in India is adorned with several noteworthy names who have turned the market to their favor with their shrewd strategies and sharp insights. First, we have Rakesh Jhunjhunwala, often referred to as India's Warren Buffett. Jhunjhunwala's investment philosophy revolves around long-term investment and meticulous company research. He believes in investing in companies with strong management and growth potential. Next, we have Radhakishan Damani, a retail tycoon and astute investor. Damani's success can be attributed to his patient approach and his knack for identifying undervalued companies. He emphasizes the importance of patience and consistency in the investment journey. Last but not least, Nemish Shah, a low-profile yet highly successful investor. Shah's investment strategy relies heavily on identifying macro trends and investing in sectors that stand to benefit from these trends. These investors may have different strategies, but they all share common traits: patience, discipline, and a deep understanding of market dynamics. They recognize that the stock market isn't a lottery, but a platform where research, patience, and informed decision-making can yield significant returns. So, what can we learn from them? Research, be patient, stay disciplined, and understand the market dynamics. Keep an eye out for companies with strong fundamentals and growth potential. And most importantly, remember that investing is a marathon, not a sprint. By understanding their strategies and keeping an eye on market trends, you too can potentially emulate their success. Now, how does the stock market work? Think of the stock market as a grand marketplace, but instead of fruits, vegetables, or other commodities, this market deals in stocks. Stocks represent ownership in a company, and buying shares means you're purchasing a piece of that company. The marketplace where all these transactions happen is called an exchange. In India, we have two major exchanges, the Bombay Stock Exchange, or BSE, and the National Stock Exchange, or NSE. These exchanges provide the platform for buyers and sellers to trade shares of publicly listed companies. But what determines the price of these shares, you might ask? It's a classic case of supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell a stock than buy it, the price drops. However, it's not that simple. Various other factors like the company's performance, economic indicators, and global events can also influence stock prices. For instance, if a company reports higher profits, its stock price could rise. Similarly, a recession or political instability can cause stock prices to fall. This is why it's so important to stay informed and understand these dynamics. When you grasp these elements, you're better equipped to make sound investment decisions. Understanding these dynamics is crucial for making informed investment decisions. Ever heard about blue chips, mid caps, and small caps? These are categories of stocks that can guide your investment decisions. Let's break them down. Blue chips are the big players. Think well-established companies with a history of steady performance and reliable dividends. They're like the elephants of the stock market, large, strong, and stable. Then we have mid-caps, the middle children of the stock market. These are medium-sized companies that balance growth potential and risk. They might not be as stable as blue chips, but they offer moderate growth potential and a reasonable level of risk. Finally, there are small caps. These are smaller companies with significant growth potential, but also higher risk. They're the wild cards, the ones that could be the next big thing or could just as easily stumble. These classifications help investors make more informed decisions based on risk tolerance and growth potential. What are multi-baggers, you ask? Well, brace yourselves for a thrilling concept in the stock market. Multi-baggers are those golden tickets, those stocks that have the potential to multiply your investment several times over. Imagine investing in a stock at 10 rupees and watching it grow to 100 or even 1,000. That's the magic of multi-baggers. However, spotting these hidden gems before they skyrocket requires a deep understanding of market trends and company fundamentals. It's not for the faint-hearted. The rewards can be colossal, but the risks are equally high. Therefore, it's crucial to conduct thorough research, be patient, and exercise caution. While investing in multi-baggers can be highly rewarding, it also requires thorough research and caution. So, that's a wrap on our beginner's guide to the Indian stock market. We've debunked some misconceptions, explored its reputation, and introduced you to some successful investors. We've also explained how the market works and discussed different stock categories and multi-baggers. Remember, the key to successful investing lies in understanding the market, learning from the best, and exercising patience. With understanding, patience, and calculated risks, you too can navigate the exciting world of the Indian stock market. Thanks for watching.